Nigeria's economy managed to continue its slow progress out of recession, up 0.5% in terms of growth in the first quarter, but inflationary pressures are still a concern, although it moderated slightly in April to 18.12%. So what can we expect from the committee at its third meeting this year? Bismarck Uwani, the CEO of Financial Derivatives and member of the Presidential Economic Advisory Council, joins us. We also have Gregory Cronston, Head Macro and Fixed Income Research at FBN Quest. Mohamed Abu Bashar is the Director and Head of Macroeconomic Research at EFG Hermes. And Chamberlain Peterside, the CEO of Exelon Capital Advisors, joins us for this conversation. Gentlemen, thank you so much for your time. I'd like to start with you, Bismarck. What's your call? It's likely to be no change, I guess, when you consider the inflationary pressures and the slow growth.
Yes, no change. What we need to look at is what will happen at this meeting and what happened before this meeting in terms of policy, in terms of data. The data shows very, very mild improvement in terms of GDP. Compared to last year, this time which was 1.6, it's down now 0.5. Compared to potential GDP growth rate, it's 8% potential GDP growth rate 0.5, so it's 7.5% recessionary gap. Having said that, inflation came down mildly, just to 18.1 to still very high. And therefore, the chances, the probability of any change or any rate hike is low. But what has happened in the meantime is the adoption of the NFX rate as the official rate. In other words, it reduced the number of layers of exchange rates from 5 to 4, I think. And then the amount of liquidity mop-up, which a rate hike would have induced, it will be taken care of by the exchange rate adjustment, which is about 3%. So moving from 380 to 410 or 411 is significant enough. I think those things, and the fact that T-bill interest rates have actually gone up marginally, and at least on the long end of the curve. So I think, generally speaking, policy-wise, we're moving in the right direction. It's a bit late. We should have done this 2 years ago, but we're doing it now. But like they say, better late than never. I don't expect any change.
All right. Thank you for that. Let me move over to Mohamed now. Mohamed, I think we can clearly see stagflation. I think we continue to hear about that in terms of the slow growth and high inflation rate. But if we unpack the GDP numbers, what stands out for you in the first quarter numbers? And potentially, how can the central bank help to really get this growth moving in the right direction?
Sure. Thanks, Wally, for having me. I guess what really stood out in the first quarter numbers is obviously overall growth was slow, but I think if you try to dissect also the trends in the maybe more business-oriented sectors in the economy, I mean, it shows that actually things have slowed compared to the fourth quarter of last year. So you have non-oil GDP growth, slowing to 0.8% from 1.7% last quarter. We have also, if you exclude oil and agriculture as well, you look really at the business economy, it just grew by 0.3%. It was just 1% the quarter before. So clearly showing, very disappointing level and trajectory, for growth. I mean, we should have seen kind of things continue to pick up, but even the very kind of shy recovery in the fourth quarter has not been gaining pace. And I guess that's probably for me the key takeaway from the numbers that we've seen. And totally agree with Bismarck here that that's not something to encourage the central bank to take action anytime soon.
Right. If I can go to Chamberlain, you can clearly point to the insecurity in the country as a key factor that has impacted the slow growth rate that we're seeing recently. But many will speak to the low level of foreign and domestic, indeed, direct investments that we have seen certainly over the last 1.5 years. Your take on whether or not we're likely to see a rebound in investments, and if so, what do you think is going to drive that?
Thank you, Wally. I believe that you just made a clear point there that insecurity is a key factor in driving both foreign direct investments and foreign portfolio investments. Unfortunately, that scenario had worsened over the last few weeks or months. The height of it might have been the NSAS campaign that occurred end of last year that could have precipitated the current sluggish pace of FDI inflow. Could that trend be reversible? Yes, I believe, with a combination of both central banks' policy measures, but more importantly, leadership on the political front. You see skirmishes here and there, which have been occurring between communities, between herdsmen, and then in the recent weeks, we've seen the certain state politicians, governors, waiting to try to ban, open grazing.
Right.
I believe that the factors that can turn the table for the country for the better would be strong political action, very, very concerted and coordinated political action on the part of the political leadership, both at the center and in the states. If that is done successfully, or the earlier they begin that step, the better it would be. It would give a good sign to the investment community that, hey, these guys have a foothold on their problems. They understand their problems and they're handling it well. If that is not done, then I guess we'll continue to see a wait and see approach that the investment communities have decided to take, especially the foreign investors and to some extent the domestic investors. There's a lot of investment decisions that are on hold that would rather, people would rather, wait and see how it plays out. That's not good at all for us.
Right. Gregory, I think Chamberlain has made a very important point where you really can't leave the politicians out of this rebound story. And more so when you consider where Nigeria is at the moment, there has been so much talk about the insecurity, growing insecurity indeed, across the country. That is scaring off investments, not just foreign, but indeed domestic investments. But if we move over to the central bank, because it really will take a combination of both the macro and monetary authorities getting their acts together, and of course the politicians. But what would you like to see from the central bank in terms of policy action that could stimulate more foreign investments, both for domestic and direct and portfolio investments?
Okay, well, the central bank, first thing I'll say is that the central bank actually has got a lot of weight on its shoulders. And the reason I say that is that most of the strain has been taken on the monetary side rather than the fiscal side in the response both to the earlier recession and, of course, response to the pandemic and the measures taken to fight back against the pandemic. So the central bank's got a lot on its plate. Well, two things. One, what is it likely to do, and what do I think it might want to do? What it's likely to do, I think we're going to see an expansion of the development finance role. I've probably said this before, but the role has been expanding very rapidly. And for example, the last several communiques from the MPC give out your figures. X has been dispersed under credit scheme Y since Z, and there's a lot of details. So this is something which the central bank is very keen on and is going to do more of. And we should remember, of course, the rather large overlap between membership of the MPC and senior positions of the central bank. So that's I think is what they're going to be looking to do. What could they do to direct investment, portfolio investment? Direct investment, I don't think there's a huge amount they can do. Some people will say, well, the exchange rate, but actually, if you ask me, the main reason FDI is so poor in Nigeria and has been for several years is not really the exchange rate. It's going back to what Chamberlain was saying, which is about the quality and the rapidity of political decision-taking, or maybe the lack of it. I think that's the main disincentive, allied to insecurity, of course. So I do think, now what can they do for portfolio investment? Well, they've done one thing, obviously. We all remember where the yields were, returns were on fixed income instruments at the end of last year, the low point in November, December. Right. And we all know how much they've retraced ever since. And the process has got a little further to run. But your foreign portfolio investor, so the rates now probably look pretty good. If you talk about the foreign investor, if you compare with other jurisdictions, the Nigeria returns on surface probably not bad. But there is the little matter of the pipeline, or whatever it's officially called, the backlog, the pipeline. So, if you're on a queue, and there's a debate about how big the queue is, okay? If you're on a queue waiting to get out, and there are some people definitely in that position, are you really going to want to come flying back into the market? Okay, you might reinvest some block funds, but that's not quite the same, is it?
That's an interesting point you're making. And Bismarck, if you can unpack that a little more, I think Gregory is making a point that some people are already on a queue on their way out. Is there really anything you can do to get them to bring the money back in? And if the whole point of your policy is to do that, to make sure that more money flows in, then it's. I just want you to analyze that situation for me and give me your thoughts. If you can unmute yourself, because we can't hear you right now.
There's the rhetoric and there's the action. The rhetoric is about having a floating exchange rate. The actions are having a fixed exchange rate. So what needs to be done is to actually align the rhetoric with the action. Once people know that they can predict with certain amount of certainty what the rates will be, because you know what the fundamentals, then they will bring money in. They cannot have a situation where they bring money in and hope that the exchange rate depends on how the spirit drives us. So, but I think that the fact that we have moved from the official rate to the NAFEX rate, I think that's a great move in the right direction. We should have done it 2 years ago, like I said earlier. But now, the next thing to do is to actually disburse and put supply in the market. Clear that backlog, $2-3 billion. The reserves go down to $30 billion. So be it. But that time you restore confidence, and the monies that will come in will more than replenish the $3 billion of reserves that you have actually disbursed. So if you do that, your actions and your rhetoric will be the same. Confidence will be restored, at least gradually, and then the market will stabilize. I can assure you that the Naira will begin to appreciate in the parallel market because of that. Because the effective exchange rate today, PPP is about 507, but the effective exchange rate which we are using today is anywhere between 440 and 450 if you take the weights of each segment of this market. So the market can easily clear if you allow the I&E window go up to 420, 422. You will see the other one will come down, and then if you put $2-3 billion into the market, we may begin to see something between 420 and 430 as a unified exchange rate, and the market can live with that. Right now, people are pricing their products at 460 and 470. Anything, if you unify rates at about 430, you are actually going to bring inflation coming right down.
Right. Mohammed, and we should be going to the central bank shortly, but if you can just speak briefly to this. Gregory obviously took us back and reminded us that once upon a time, in November, December, we had perhaps single digits yields in the market, and I think many people can't even remember that anymore. But do you think, given where inflation is at, that we could see yields even move further up from where they are at now?
Yeah, I think that is much needed because of where inflation is, and because of just also your previous question about like what would bring foreign investors back. I mean, there's the leg of adjusting the currency. Obviously, that is an absolute must that needs to be done. But also there needs to be an adjustment to inflation, to rates. I mean, to accommodate the elevated inflation that we see, and a possible further leg of a mini devaluation just to align market rates together. So I think the obviously we've seen a decent adjustment. I mean, we were just like almost 0.5% for the 1 year T-bill at the end of last year. Now we're like 10-11%. So that has been a decent adjustment. But again, I think where inflation is right now, and maybe even if we talk about a more normalized rate of inflation, because now inflation is excessively high, I think we still need to see rates still a bit higher just to, accommodate just the return of foreign investors.
Thank you so much. All right, Chamberlain, if we can unpack
Yeah.
some of the macro data, starting with the GDP numbers. Yes, very moderate growth, about 0.5%, below the consensus expectations, I must mention. But I think everyone is still happy. It's still growth. But I'm a bit concerned about that. Obviously, we've got to tie that to population growth. So clearly, we are not catching up on that. And what that means is potentially a lot more poverty. If we take a look at the inflation numbers, that also, I think, may not be telling the entire story when you look at the headline number at somewhere around 18%. If you look at the food inflation numbers, it has been over 20 for a while. And that is the number that really impacts most Nigerians, the food inflation number.
Yeah.
So the macro story is not great. We know that, but I just wanted to hear your thoughts on how concerned you are about the direction of the macro statistics right now.
Well, I'm quite concerned, despite the fact that you rightly pointed out that every growth is growth, no matter how marginal. We've seen negative growth in recent quarters turn to slightly marginal growth the last quarter. That said, what worries me the most is the food inflation and the overall inflation numbers. The scariest part of this whole process, is the stagflation that we are currently experiencing. Central bank in the past had toyed with the idea of keeping inflation low to be able to, at the expense of growth. And we had argued in this session previously as to whether or not central bank should pursue a pro-growth policy at the expense of higher inflation. But here we are now in a scenario of slow growth that is capped with high inflation.